Hi there, welcome to my channel where I dive into fascinating economic trends and analyze their impact on society. This video is sponsored by Momoretsoch Tech and Tools. In the rapidly evolving world of financial markets, the process of decision-making can be an overwhelming endeavour. Investors and corporations are inundated with copious amounts of data and information, rendering comprehensive analysis of every available option an impractical task. In this context, the concept of satisficing emerges as a guiding principle, steering financial decision makers toward adopting streamlined heuristics and effective strategies to navigate the intricacies of the financial landscape. In today's discussion, which is part of the Financial Market series, I discuss the impact of satisficing on financial decision making, both within the scope of investment behaviour and the financing choices of firms. It accentuates the advantages and potential drawbacks inherent in this approach. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. Financial markets are awash with data, news, and opinions that can obscure decision making. The attempt to meticulously process and analyze this information is impractical and time-consuming. Consequently, investors often resort to satisficing to swiftly sift through data, zeroing in on key indicators or trends that shape their investment decisions. Investors, whether institutional or individual, face limitations in terms of time, expertise, and computational power. Satisficing allows them to judiciously allocate their resources towards analyzing pivotal aspects of investments, steering clear of the paralysis induced by information overload. Financial markets are marked by high volatility, and delays in decision-making can lead to missed opportunities or undesirable outcomes. Satisficing empowers investors to make timely decisions by concentrating on pertinent factors, sidestepping unnecessary complexities. Rather than chasing the most optimal investment, investors may opt to meet specific risk-return criteria. By identifying investments that align with acceptable risk levels and their objectives, they can construct diversified portfolios that strike a balance between risk and return. Like investors, companies contend with limitations in time and resources when searching for financing options. Engaging in exhaustive analysis of every potential funding source can be unfeasible. Therefore, firms might embrace satisficing by selecting readily available financing solutions that cater to their immediate needs. Firms must assess the costs and benefits of various financing alternatives. Satisficing allows them to consider the most obvious and straightforward choices, which may be adequate for their current requirements, without delving into more intricate possibilities. Economic conditions and market uncertainties can impact firms' financing decisions. When the future is uncertain, firms might adopt satisficing by favoring conservative or conventional financing options that provide stability and lower risks, instead of exploring more speculative alternatives. Satisficing may prompt firms to rely on existing relationships with lenders or financial institutions. Familiar sources of financing might be preferred due to established trust and familiarity, even if better terms could be secured elsewhere. Satisficing facilitates swift decision-making, enabling investors and firms to promptly respond to market opportunities and challenges. By circumventing exhaustive analysis, Satisficing preserves time, energy, and other valuable resources, rendering it a pragmatic approach in fast-paced financial markets. The simplicity of Satisficing eases the mental burden on decision makers, averting decision paralysis and mitigating the stress stemming from excessive analysis. On the other hand, by foregoing exploration of all available options, investors and firms run the risk of missing potentially superior investment opportunities or financing terms. Satisficing may yield satisfactory outcomes, but not necessarily the best conceivable results. In certain instances, more comprehensive analysis could have led to better decisions. Simplified heuristics can be vulnerable to cognitive biases, resulting in suboptimal financial choices driven by irrational decision-making. To recap, Satisficing stands as a pragmatic and adaptive approach in the realm of financial decision-making, enabling investors and firms to effectively navigate the intricacies of the financial landscape. By setting acceptable thresholds and concentrating on essential factors, decision makers can evade analysis paralysis and arrive at timely choices. Nonetheless, Satisficing entails trade-offs, as it may lead to missed opportunities and suboptimal outcomes. Striking a balance between Satisficing and more comprehensive analysis remains imperative for attaining sound financial decisions that fulfill objectives, while considering resource limitations and the uncertainties inherent to the financial world. That's it for today's video. I hope you found this analysis insightful. If you did, please like this video and don't forget to subscribe to our channel for more engaging content like this. As always, I appreciate your support. Thank you for watching, and until next time, stay curious and keep exploring the world of economics.